Okay, so maybe let's officially start. Thank you again for joining us on this Thursday evening, whether you're joining us from Singapore or Malaysia, Hong Kong. Believe a few people from Dubai might also be joining us today. I'm Nandini. I'm the Deputy CEO in the company, and I'll be your host this evening. And obviously, the purpose today is for our CIO, Stephanie, to do a really deep dive sharing on both our results as well as the outlook for Q4. Just a little bit of information in the sense of housekeeping. You can share your questions via Q&A if you are on Zoom link with us, or if you are on YouTube, you can share your questions in the Q&A in YouTube, and we'll make sure that at the end we try to cover as many questions as possible, and Stephanie can share her views on it. Great, want to kick this off, so just maybe 5 more seconds if people want to answer, where did you invest most your cash in the last 12 months? While there's been a bit of volatility, obviously, as we'll all see, market performance has been quite strong, and that's great. A lot of long-term portfolios, that's what we like to see. When people think long-term, we always say retirement is your most expensive goal, and make sure you are securing that. So thanks very much for sharing the responses, and we can go back to the presentation. Great. So just a little bit of housekeeping. So this is really for educational purpose. It's not a direct recommendation or advice, and nor any tax advice specifically. So please do make sure that you do consider your own one-to-one situation before taking a decision on any financial product. Next, so if you are, I know there are a lot of clients in the call today, but if you're joining us on YouTube, or you found us in this webinar and you don't know exactly who we are, so at Stashaway, we're a digital wealth manager. Our purpose is really to make investing simple and cost-effective for people, but making it simple and cost-effective to invest intelligently. For us, what intelligence means is that you have a diversified portfolio, you have a portfolio that really caters to your long-term needs or short-term needs, whatever may be your purpose, that's what the product is built for. And you are not having to take a lot of time to manage your money. We've been very lucky to be recognized, both from the fintech, but as well as from the consumer space for what we do, and really thankful for that. We're today present in 5 countries, Singapore being our home base, but we are regulated as well in Malaysia, Dubai, Hong Kong, and Thailand. We've also been very fortunate to have some, really big global investors believe in what we are building over here. So we are supported by venture capitalists like Sequoia and the arm of Fidelity, but also by institutions like Hamilton Lane. So with that, I'll pass the agenda on to Stephanie so that we can really get into the meat of today's purpose. Thank you.
Right. All right, thank you, Nandini, and great to see all of you virtually, although I can't see any of you, but I think a lot of you have been with us for quite a number of years, so welcome again to our quarterly webinar, where we're going to talk about a review of the last quarter, but also, most importantly, what's in store for us for the next few months. So tonight's agenda is very, very straightforward. As I mentioned before, a bit of a portfolio and market review, and then our thoughts on the next few months, and then we will leave plenty of time for Q&A. But of course, like during the presentation, if you have any kind of burning questions, you can always type it out in the chat as well, and we'll be sure to address that either online or afterwards. So without further ado, let's look at what has the market served us. So I think for a lot of clients and a lot of friends who have been following Stashaway for quite some time, you might have noticed that this year, when we put out our 2025 market outlook, we title it "Fat is the New Normal." And fat is, of course, sometimes a nice thing, sometimes not a nice thing. But in our context, we basically refer to three things, which is F, which stands for fiscal dominance. A stands for artificial intelligence, and T, of course, stands for Mr. Donald Trump. I don't think I need to explain a lot more on AI and Trump. We've all kind of experienced it on a daily basis or on headlines. But fiscal dominance may be a bit of explanation for those who have not come to this term before. So I think if you think back to kind of the 2007, 2008 financial crisis, what happened afterwards was basically market cycles that are driven mostly by monetary policy. By monetary policy, what I mean is the central bank actually doing QE? Is the central bank doing QT? Are we increasing interest rates, cutting interest rates? That has been the predominant kind of market driver. However, since COVID, that has sort of like been changing direction. So when we say fiscal dominance, it's basically what the government wants to instill in the economy from kind of the liquidity perspective, from how much money is it's kind of subsidizing different industries or different consumers' perspective. And since COVID, I mean, this has actually been the driving force of the liquidity kind of cycle in the US. And FAT, the three things, is actually quite intertwined. And I think this year so far, we've seen that play out in many different aspects. So if we rewind back to the second quarter, it seems to be quite distant, but I'm sure a lot of us remember April when Trump announced the trade tariff policies. So 2Q, if I think from the framework of FAT, was really about fiscal dominance. Remember, like Germany passed bills to spend more on defense, and then of course like Trump policies with the trade tariffs. And these things were making headlines and also creating waves in the market, which we've captured during the previous webinars. And what happened to the third quarter? During the third quarter, during the past 3 months, actually artificial intelligence was back to be the main focus, and the market was mostly focused on a recovery from the trade tariff, but a lot of the recovery was actually focused on the AI theme. So again, the three things FAT kind of continue to play out in separate kind of time frames, but also interlinked. So here, I've actually pasted a chart of how does Nvidia, which when I looked at the chart, Nvidia was in the middle, which is 4.6 trillion in terms of market cap. Of course, I mean this week it broke 5 trillion. So how does the market cap of Nvidia, which is of course the biggest company in AI and also kind of globally, how does it compare to GDPs of countries? And you can see here, it actually exceeded the GDP for Japan and also exceeded Germany recently. And the only countries that have bigger GDP compared to Nvidia, which is just one company, is China and US. So it shows you like how big the scale we're talking about in terms of AI. These are kind of scales on par with countries. And that's why it's one of the biggest driving force of not just kind of, I guess, equity market, but also kind of throughout the whole kind of, I think, the whole context of asset markets. And just a big quick recap on performance year to date for different asset classes. At Stashaway, we think about all these different assets in four broad asset classes: equities, bonds, ultra short dated US Treasuries, which is kind of the cash equivalent. So think about it as cash. And then lastly, of course, like one of our favorite topic, which is gold. And here you can see that gold, which is in yellow color, has significantly outperformed all the other assets. returning, as of end of Q3, it was 45% year to date. But of course, 2 weeks ago, it was rallying as much as 60 something percent year to date. So very, very strong performance for gold. This is followed by global equities, which was up 19% up to end of Q3. And bonds was also rallying, although to a much lesser extent, up 7.4%. The asset class that really underperformed in this year was actually cash. So when we did the poll, and a lot of people said they've actually invested cash into other riskier assets. That's a great thing. That means that you've captured actually more returns this year compared to just sitting in cash. And of course, like cash has the property of like just moving in a straight line because you collect sort of like very, very stable interest. So during times of stress, for example, in earlier this year in April, you can see here, equities actually took quite a big dip. It was down from top to bottom, almost kind of 20, well, I guess 15% in the midst of the trade tariff concerns. And if you were to build diversified portfolios, this is exactly why you need kind of balancing assets, defensive assets like gold, bonds, or even cash equivalents, because that helps you to mitigate that drawdown and helps you stay invested to actually reap returns in the longer term. And of course, gold has rallied a lot, but we like to also kind of view it from a historical context. So for those of you who have been with Stashaway for quite some time, you may have remembered that we actually included gold in our asset allocation starting from kind of April last year. And one of the big reasons was because of the kind of structural shift of fiscal dominance, which means that government debt will become will increase in terms of supply, meaning that interest rates actually may stay higher for longer. And in that kind of environment, we view gold as a better safety asset compared to bonds, compared to government bonds. And that's why we included gold in all asset allocations. However, what we didn't anticipate was, of course, the kind of at the peak 66% return of gold in less than a year. And if you look at this chart, it basically shows you the historical analyzed return of gold. Going back to 1921, so 100 years of history. And on average, gold returned about 7% per year. If you look at kind of the right side, which is the tail, the biggest year for gold was actually 1979, where it returned 127% after the oil shock and inflation surge. But 2025 was actually also a very, very outlying year. So 2025, if we took kind of the highest point, analyzed return for gold was about 90%. So this is something that's very, very extraordinary. And although in the short term, we may see some volatility in terms of gold, given how extraordinary it has been, in the long run, we're still positive on the asset class, particularly compared to bonds. So just to give you some context as to how well gold has done. And I mentioned about AI being a driving force in the third quarter. Now, of course, if you had a portfolio of gold plus AI stocks, would have enjoyed very, very good returns, because in the Q3 market rally, it was actually quite concentrated, or even if you look at year to date, the returns was actually quite concentrated in the tech sector. And this chart shows you basically two bars. The lighter bar is the year-to-date return for different sectors in the US stock market, and the darker bar shows you Q3 returns. So if you take a look at the top sectors, information technology, communication services, consumer discretionary, these three sectors are very, very much focused on, is actually dominated by big tech. If you look at consumer discretionary, even though it's not a tech sector, the biggest stocks there is actually things like Amazon, which is, of course, one of the cloud hyperscalers tied to AI development. And communication services actually has Google as one of its biggest component. So if you look at these three sectors, they vastly outperform the other sectors in the US, which is why I said in Q3, the focus was really back to AI. And if just a quick reminder for those of you who are new to Stashaway portfolios, when we think about kind of asset allocation, we basically have a kind of longer term strategic asset allocation of these four different asset classes that we refer to. And then throughout different phases of the cycle, we tilt these allocations in order to make sure that the statutory risk index actually remains constant. For example, during a recession, typically that's when equities perform poorly and bonds would perform nicely. And that's when the tilt of the asset allocation would be more overweight bond compared to these kind of long-term asset allocations. So here you can see the statutory long-term allocations. And I mean, what we'd like to point out is that for all statutory risk index portfolios, we have actually included gold as part of that long-term asset allocation to up to 8%. And this compares to if you go to kind of a more traditional asset allocation portfolio where it's only got equities and bonds, gold would not be included in those traditional benchmarks. And given the inclusion of gold, it has continued to help our portfolios outperform traditional benchmarks on a risk-adjusted basis. Because if you think about sort of years today, we had that big dip in April, and gold was actually up during that time. So if we adjust for the, if we compare kind of the returns adjusted for the drawdowns, for the risk that you take, actually statutory portfolios have done very, very good job in terms of protecting the portfolio during volatile times. And if you look at here, this is across different kind of risk points. So some of our clients have more conservative portfolios, some of them have more aggressive ones. And on average, SRI portfolios have returned 2.5 times of returns for every risk unit that you take. And these are our portfolio returns in a more simplistic manner, which is basically the percentage return. So in Q3 2025, I'm happy to report that in general, for general investing portfolios powered by ERA Stashaway, the returns range from 1.7% to 7.1% in the high risk category. And our average return was 4.4%. On a rolling 12-month basis, the returns range from 3.6% to 15.9%, and the average was 10.8%. And if you compare that with traditional equity bond benchmarks, we actually outperform on both time horizons. And if you look at kind of the statutory portfolios, when you choose statutory portfolios, you only need to choose the SRI. But underneath each portfolio actually is a carefully set of curated ETFs or asset classes that helps to generate that kind of better risk-adjusted returns. And here's a snapshot of what goes into, for example, the SRI 22 portfolio. You can see that there are quite a number of different ETFs and they all contributed differently. But if you look at kind of the green, like the greener the bar is, I mean, the more attribution the particular ETF has done in terms of contributing to performance. So in Q3 and also in a trailing 12-month basis, both gold and also MSCI Global Equities, which is the second and third asset class, I mean, they've actually contributed the most to portfolio returns. On the negative side, consumer staples and India has detracted from performance. I mean, those are the ETFs that are in red. Going through other portfolios at the Stashaway platform, you can see that BlackRock portfolios also posted positive returns in Q3 and on a rolling 12-month basis. And their portfolios are range from 3.8% to 7.7% in Q3 and 6.6% to 7.2% on a rolling 12-month basis. And we have customers who invest in our thematic portfolios, and in Q3, and those have returned quite decently. So I won't go into details here, but I mean, you can see the numbers. And on a rolling 12-month basis, also technology enablers have significantly outperformed, averaging close to 30% return. Again, going back to the AI theme that I was referring to. So that is a wrap to our portfolio reviews, and here's to perhaps the more interesting part. But before I dive into our views, I'd like to also get some help from all of you. So I would like to sort of get your views on equities. Are you bullish, bearish, or neutral? So maybe I'll just give about 1 or 2 minutes for everybody to fill out your answer. I mean, you can go with your gut or with how you're positioning your portfolios. So I'll share my screen in about maybe 20 seconds or so that people have time to fill out the information. Okay, I think I see answers coming in, so let me share it so you can also see how others on the Stashaway platform are thinking. So 61% of our investors are bullish, 25% neutral, 13% bearish, more neutral coming in, but more people coming in to bullish as well, which is great. 66%. Okay, 67%. So I think the conclusion here is quite clear. Actually, I would say 2/3 of us here, and tonight we have over hundreds of people here. So quite a number of us are actually quite bullish. So what do we think? Let me share back my screen. So I think to answer that kind of bullish, neutral, or bearish questions, we have to ask three big questions, at least for the next few months. The first question, pretty obvious, is AI going to continue or is it in a bubble? There's a lot of talks and a lot of concerns about AI in a bubble. Second question, what will the Fed do? And of course, we just had a Fed meeting last night, so today is actually a very, very good day to talk about the Fed. And then lastly, will US-China reach a deal? Today we also have some news. So I actually put down these three big questions last week, but apparently they all become very, very timely. So let's go through them. Firstly, AI is now actually key not just for the tech companies, but it's actually key to US growth. The reason why I say this is because if you look at the left-hand side, the left-hand chart, this shows you the US GDP growth contribution from tech capex versus contribution from the rest of the economy. And the contribution from tech capex is the shade in golden color. And as you can see, just as kind of recently as about 2 years ago, that contribution was actually quite small compared to the rest of the economy. However, today, actually, the tech capex versus rest of the economy is pretty much on par. And if you look at the on the right-hand side, the chart that has three lines that plots the differences in terms of real fixed investment for different segments. There's three segments here. So information processing equipment, which is basically tech. I mean, that is the only line that went up in 2025. The other two lines, which are residential investments and also kind of other fixed asset investments, I mean, those have actually been going down. So there is basically no growth in corporate capex outside of AI, which means that, I mean, for the companies that are investing, they are all putting money into AI. And that's why that is driving significantly part of US growth. And not just for this year, but if you look at this chart, which shows you the expected capex related to AI data center build out in the next few years, the numbers are actually staggering. On the left-hand side, you can see that there's two colors. On the bottom is the darker blue, which shows you the AI-related data center capex, and the lighter line is the non-AI related data center capex. And 2025, there's total of about kind of 40 gigawatts that are AI workload. if you fast forward that to the right-hand side of the chart, which is just shows you that AI capex workload for 2030, I mean, that number actually goes up 3.5 times. And this is while the non-AI workload is staying kind of quite constant. So again, for data centers, these are kind of big numbers, and those numbers are going up very quickly as well. So over the next few years, this is going to drive US GDP growth, and probably not just US as well. Right? If you kind of look at the data, this is showing global data center, and a lot of that is happening also in countries like China, obviously, but also in Dubai. There are announcements in Europe, so all the countries are actually growing their data center capex very aggressively. But with this, also, it comes the question of is AI in a bubble? And on the left-hand side, you can see a chart where this is a Bank of America Global Fund Manager survey. So they actually ask global fund managers every month for their views on the market, pretty much like what we've done just now, but they do it on a very regular basis. And one of the regular questions that they ask these fund managers is, what do you think are the top tail risk? And for the first time, 33% of fund managers says that AI equity bubble is actually the biggest tail risk. This shows you that fund managers globally are actually concerned about whether we're at the end of this AI investment boom. And just 2 months ago, that concern was a lot lower. And of course, if for those of you who have been following news flow in the sector, there's been a lot of announcements with OpenAI investing or kind of buying, making deals with all the other kind of hardware companies, including NVIDIA, Oracle, AMD, etc. So on the right-hand side, this is a chart that Bloomberg kind of put together. It shows you it's got a lot of arrows, but the gist of this is basically all these companies are basically interconnected in their fortune because one company is buying from the other, which invests in the other. So there's also a question about this financial web that NVIDIA and OpenAI is basically building. So the question is, as I posed before, are we actually in an AI bubble? Is this going to bust? So this is a chart that shows a analysis which tries to look at the AI investment kind of I guess development in 5 different aspects, including number one, is it an overwhelming part of the economy? So on I guess on the top left-hand side, economic strain, compared to other previous bubbles. Like these bubbles include, for example, the railway bubble, the oil bubble, etc. So from that aspect, AI investment, AI capex is still reasonably kind of low percentage of GDP, even though it's increasing. But from that aspect, it's still green. And industry strain, which is investment versus revenue, this is kind of more in the yellow category because, as we all see, companies like OpenAI, for example, they're promising a lot of investments based on revenues that are in the future. So there is a bit more strain. On the right-hand side, revenue growth, this is still growing very nicely. So I think one major difference between this time and some of the other bubbles, I think most recently, for example, the crypto bubble that we've seen, was that revenue was actually not catching up to the investments. And I think this is a very important differentiation of the current AI development, which is that you're seeing real revenue coming in. And companies like OpenAI or Anthropic, they are not just doubling revenue, but actually they're growing revenues 3 times, 5 times, etc. So that is the supporting element for AI not being in a bubble. And then lastly, I think valuation are, if you compare the private companies to the public companies, private companies are still okay. Of course, the public companies are a bit expensive, but as I'll show you in a later slide, it's also still not in a bubble territory. And funding quality is something that I'm going to talk about as well. So, but that is still in green. So all in all, we have some amber, but nothing is sort of in red still that shows you AI is in a bubble. So I promise you a valuation comparison, and this shows you the US tech sector price to earnings ratio history. On the right-hand side is the latest PE. This is trailing PE, so it compares. Basically, what it calculates is if you take the current price and divide that, or current market cap, divide that by the earnings that these companies are making in the past 12 months, what is that ratio, right? How much are you paying for each dollar of earnings that has been generated by these companies? Currently, that number stands at around 43, so it's expensive, and it's probably the most expensive in the past 20 years. But it's still not kind of at the dot-com bubble peak. And I mean, that sort of, I guess, compared to previous bubbles, the current trailing valuation still looks to be more kind of, I guess, less in a bubble territory, but also quite extended. Now, I mentioned that this is a trailing comparison. So if you assume that revenue and earnings can grow faster in the future, I mean, this number will go down, assuming price don't increase. So again, back to kind of where that revenue generation is coming. Of course, I mean, when we talk about AI investments, a lot of companies are investing in AI because they believe that in the future they're going to be able to generate these returns. And I guess from a macro perspective, we like to actually gauge what is the scale that we're talking about. As I mentioned before, we talk about scales in terms of countries. So what is exactly that number? And here's an estimate done by McKinsey. They basically estimate that in the next 3 years, there will be about 3 trillion of capex spent on data centers. And the question is, where is that money coming from? The good news is that about 1.4 trillion can be covered by hyperscaler cash flows, right? The Max 7 actually is very, very cash generative. Even though we don't pay for a lot of the service, they actually get a lot of the revenues from advertising, for example, for Meta and Google. And then the cloud service providers actually charge their customers on rental for these cloud infrastructure. So 50% of the cash flow is actually covered by the big tech companies. The bad news is, of course, there's still half, 50% that is not covered by these companies. So I guess what McKinsey has kind of mapped out here is that there are different ways to raise that money. And that, of course, includes debt issuance, some kind of private opportunities. Private credit is also a very, very important source of these capex spend. Now, the good news is that there is actually a lot of room still for the US economy to level up in the private sector, meaning that companies can still borrow money. And I think this is actually one of the maybe more surprising chart for most people, because when you read the news, like the headline also always refer to credit problems. And of course, there's been a number of I guess loans that have gone bad in the most recent bank earnings season, and Jamie Dimon referred to bad cockroaches. But if you look at this chart basically shows you a long history of the US credit to GDP gaps, which means that if you kind of look at where credit is compared to where GDP is, when there's a debt problem, this line tends to be positive. For example, in the 1990s, we had the US S&L problem. More recently, during 2008, you can see during the global financial crisis, actually the credit gap is actually as much as 10%. And when this number is negative, it means that there is actually room to create more credit. And today we're actually sitting at negative 12% of GDP, which means that actually there's a lot of room for the private sector to raise credit, raise debt, which can be used to fuel all sorts of activity, including AI investments. And the other thing is when a lot of people talk about fear for recession, one of the best leading indicators of a recession is actually how healthy is the US corporate in terms of their cash position and debt position. And here on the left-hand side, you can also see the corporate sector debt as percent of GDP, which shows you that actually, I mean, we're still very, very at a very healthy level compared to, for example, previously in 2020, I guess Q2 before COVID, corporate debt was at 42%, and today we're only sitting at 31%. On the right-hand side, you can also see kind of the cash profits growth for US companies, and they're still going up in a pretty nice straight line. So with this backdrop, the US economy is very, very unlikely to fall into recession. And also, I mean, this kind of healthy corporate balance sheet helps to fuel the AI investments. Of course, I mean, we've also seen some recent news as to how these Mac 7 companies are using some more creative financing to kind of fund their AI investment capex. Most recently, Meta actually announced a deal to fund the data center that they're building, and I just kind of I thought it was a good kind of case study here, just to show you all how all this is going to be funded, perhaps in the future. So, for example, for this particular data center, it requires 30 billion in terms of investments. And the key investors are Blue O, which is a alternative fund manager. They would invest 2.5 billion in terms of equity. For the rest of the deal is actually going to be financed by bond buyers. And these bond buyers include the ones that are below, which are the likes of PIMCO and BlackRock. And you can see that actually the data center kind of debt is going to be snapped up in ETFs. So by actually investing in ETFs, you are actually also indirectly, or by investing in these bond ETFs, you're also kind of indirectly investing in the AI economy. So just to show you that, I mean, how broad AI is actually affecting different asset classes. So I mentioned a few good news, bad news. The next bad news, I mentioned about the last one was the good news, which is that, I mean, there's plenty of cash to go around to fund it. The bad news is that there's more than one entity asking for cash. The US government is also actually asking for debt, for cash. And this is a chart that I've shown before. And this is one of the pillars of Fed, which is fiscal dominance. So when a government needs to spend money, of course, they need to raise capital. And for the US government, they are planning to spend a lot of money over the next 20, 30 years. And their own projection shows that government debt, US government debt, is going to go up as well. So, for example, today, if you look at this chart, US government debt as percentage of GDP is around 110%. That is projected by US government's own agency to go up to 150% by the end of 2050. So that is a significant step up, and that would create actually more demand for capital, not just for AI. The good news is that, I mean, the previous slide was actually a projection. And I think so far this year, we've actually seen US debt staying quite constant. So 2024 US annual budget deficit was 1.8 trillion. And so far this year, that budget deficit for the US government stays quite constant at 1.8 trillion. And if you look at the right-hand side, one big reason why the budget deficit has not worsened is because of the green bar, which is revenue collections, which means that if the economy is strong, the government actually collects more in tax revenue, and that supports the spending, the extra spending that they've planned for. So that's why for the government, this is actually one of the most key drivers to ensure that they stay healthy in terms of the fiscal balance, which is not that different from how we think about our personal fiscal situation, right? We always want to earn more money so we can afford to spend more. So the government is actually exactly the same. So when everybody's asking for money and when they want a strong economy, who do they turn to? And obviously, I mean, Trump wasn't happy with Powell because Powell was quite resistant to the idea of lowering interest rates. And of course, the Fed is the only agent that can print money that would allow the economy to stay afloat and also would allow the government to spend. And that's why the second question is, would the Fed keep the music going? Because the moment the Fed says music's off, everybody out, then I guess there's a lot of dominoes to fall. We just published our 4Q outlook, and in the piece we actually did a kind of a analysis on not just AI but also jobs market, because jobs market is actually what the Fed looks at. And this chart shows you kind of the change in unemployment versus 1 year ago for different sectors. I think the gist of this chart basically shows you that most sectors, or if you look at the top, leisure and hospitality, education, blah, 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 I mean, these are sectors that have seen rising unemployment. So it's actually quite broad. A lot of sectors are seeing rising unemployment. The only sectors that are seeing kind of lower unemployment is transportation, agricultural, and interesting financial activity. So I guess we're in sort of in demand, but overall, the U.S. jobs market is actually cooling down. And this actually gave the Fed the ammo to start its rate cutting cycle. These charts are basically what so the Fed actually publishes their own projections after they've had a meeting. And actually, it's quite detailed. It shows you not just the current decision, but also the Fed members' projection for unemployment rate and also inflation in the next year and also over the long run. And here, if you look at the left-hand side, that's the Fed's projection for unemployment rate. So the top chart shows you the projection for 2025, which most of the Fed members think unemployment rate would be between 4.5 to 4.4%. But for next year, actually, the more participants actually think that the interest rate, the unemployment rate, may actually start to kind of I guess stay around 4.4 and 4.5, but there's increasingly kind of projections for higher unemployment rate. On the right-hand side, this is a similar chart for PCE inflation. And again, if you look at these two charts, the more Fed members actually think that PCE inflation will come down in 2026. So they are actually more worried about growth than inflation versus a few months ago. And obviously, the Fed had its meeting last night. 2 nights ago. And basically, the Fed announced a 25 basis point cut. And also, I think more importantly, they announced the end of QT. And this chart shows you that the Fed, on the top, the Fed's balance sheet basically was, they were trying to shrink their balance sheet for the past few years. And now they're saying that we're done. We're done kind of shrinking the balance sheet. They're not ready yet to say we're going to increase the balance sheet. But I think stopping the shrinking actually already is injecting liquidity into the system. So that is supportive for risky assets. And of course, the big question for the next few months is who's going to replace Powell, right? And this is a chart that I've taken up from Polymarket, which is a betting website. And it's quite real time that shows you the market's pricing of various candidates. And so far, I don't think we have a clear majority as to who's going to win. And it seems like the latest news is that Bessent himself may be interested in kind of entering the race again. So until Trump actually announces who's going to be a Fed chair, there's a lot of uncertainty here. And I mean, this will probably create quite a bit of volatility. But at the end of the day, I think the number one is that the Fed has started its cutting cycle. And then number two, I think the market will increasingly kind of price in a dovish chairman. And indeed, I mean, if you look at what the market expects the Fed to do in 2026, this is a chart that shows you both the Fed's own projection and the market's real-time expectation. The market's real-time expectation is actually the lighter, the blue dashed line, and the Fed's own expectation, which is the dot plot, is actually the yellow line. Of course, for end of 2025, I mean, both the Fed and market expects 3.6% ending the year. But for next year, the Fed is not actually projecting any cut, whereas the market is actually expecting another kind of 60 to 70 basis points cut. So the market is actually more dovish than the Fed's own projection. Now, last question, will US-China reach a deal? Again, we had some news just coming in this morning. And so apparently there was a deal, but that deal seems to be kind of maybe interpreted slightly differently from Trump's perspective and Xi's perspective. And I think if you look at the details of the deal, basically US lowered tariffs on Chinese goods from 57% to 47%. China says we're going to delay whatever restrictions that we plan on rare earth for 1 year. US China will buy more soybeans, and then also Trump will visit China in April for further negotiations. I think this capture of Xi and Trump shows perhaps a differential in terms of their enthusiasm for the deal. And in my mind, I think the real deal is actually this, which is the chips, which actually didn't get included in the deal announcement. So I think this is still TBD. This is still kind of under negotiation. And as I mentioned before, because AI is such a big deal for like both economies, I think this is actually the real deal that needs to be done. So we've tried to answer all three questions. What is the conclusion? So I think well, in the Q4 outlook, or in this outlook, the title that we've come up with is AI runs hot, jobs run cool, and the Fed runs loose. That basically summarizes our views for the next few months. And what does this mean for like the ERA portfolios, or even I see some people doing your DIY portfolios. What does that mean? So for those of you who are new to Stashaway, you may not be familiar with the ERA kind of macroeconomic framework. But this is basically how we how we systematically track where we are in the economic cycle, and that guides our asset allocation decisions. So ERA basically look at economic data on a real-time basis and determine where we are in the four regimes. And the four regimes are pretty self-explanatory, which you can look here in kind of on the left-hand side. So it's basically four quadrants that are separated by where we are in terms of growth and inflation. And on the left right-hand side, you can see that there's a quadrant named good times. And pretty self-explanatory. When you have low inflation and positive growth, that's the best time to invest in equities. And you can see a lot of cyclical sectors actually rallying. Today, we are in the left top quadrant. The right top quadrant, which is inflationary growth. And this is where we have positive growth, but still high inflation. Because as I mentioned, actually, inflation is still above the Fed's target. And given all the liquidity that gets pumped into the system, we may still see kind of inflation above the Fed's target for longer. When the economy actually heats up too much, when inflation is too high, the Fed or governments will start to tighten policies to kind of lower growth, to try to lower inflation. And that's when the ERA regime shifts from inflationary growth into stagflation. And we've seen a bit of that in 2022. When the Fed increased interest rates, and actually, if you think about the equity market, it had a pretty sizable correction back then. When the economic growth actually slows very, very dramatically, it slows enough. That's when you enter a recession, where because of low growth, actually that pulls down inflation as well. And that's typically when the Fed would stimulate. If you think about the 2008 financial crisis or COVID, we've actually entered a recession, and there is a stimulus, which then pushes the economic cycle back into good times. So this is kind of a circulating or a recurring regime that we've seen again and again. Of course, each kind of episode it could be slightly different, but the mechanism and also the response from central banks and governments tends to be quite repeatable, and hence we're able to use a lot of backtesting data, a lot of historical data, to help us to create these different portfolios that are suited for different times. So given all this, we actually do not position our portfolios based on my projection of where we are, but rather we actually let the data tell us where we are. And if the data actually changes, that's when the system would actually adjust the portfolios accordingly. But what I can offer is a projection of my interpretation of data and how likely we're staying in a particular regime. And I think given all this, we're likely to remain in inflationary growth for the next few months at least. And under this environment, we remain quite constructive on stocks. we still prefer gold over bond. Although I've noted before that gold had very, very tremendous run in this year, particularly in the past few weeks. So I wouldn't be surprised that in the next few weeks we're going to see gold like correct even more. But I think correction would be a good time for those of you who do not have gold to keep accumulating gold for the long term. And where are the key risks? The key risk is, of course, that inflation picks up if the system gets overheated, and that the Fed actually tightens liquidity instead of loosening liquidity. So with that, I think this is our last poll, and this is the last bit of help that I need from all of you. So what is your investment plan for the next 12 months after listening to all this? You have four choices. A, buy the dip. B, set up a DCA plan or continue with DCA. C, reduce investments. Markets are too crazy. And D, no plan yet. And if you have a E, feel free to type it up in the comments. So again, I'll give everybody maybe 2 minutes to figure out what you want to do.
Yeah, we like the bees coming in, DCA
Yes.
in.
I think we have good enough participation. So let me share my screen. Okay. Actually, we've asked this question a few times, and I always love the answers because this is exactly why we have Stashaway, and we want you to have a DCA plan or continue to DCA. So seeing that 60% of you actually will continue to DCA is very, very heartwarming and encouraging, which shows us that, I mean, what we've built is actually something that is helpful to all of you. 28% buy the dip. That's a good strategy as well. And I think it's actually very good that nobody has no plan yet. So everybody sort of has a plan, and the key is to execute on the plan. So perhaps with that, we can start the Q&A.
Yeah, thanks, Stephanie. So maybe I'll dive right into the Q&As because a few questions came in while you were sharing. So starting with obviously the AI bubble piece that we addressed, there are comments that the big AI companies are in a self-reinforcing circular bubble, each investing in each other with basically the same pool of funds, artificially pushing up the price. What do you think? I think this is what you addressed earlier, and you pointed to NVIDIA and
Yes,
OpenAI. So
yes.
yeah, what
So
are
let
your
me maybe I'll actually pull up this slide. So so this is basically on the right hand side. This is sort of like the circular, I think, references that investors are referring to. Now, of course, a lot of this depends on whether or not OpenAI can raise money in the next few years because they're promising billions that they do not have in the bank. And if you look at the financials, they're still burning money every year. Um, but I think this is why this chart is actually important. So the global data center capex is, I mean, not just dependent on financing by the big tech companies. A lot of that is actually being financed by external investors. So investors that include, of course, the sovereign funds, investors that include kind of big, I guess, family offices and pool of capitals, but also investors like you and me right here. And I think the good news is that this capex is number one, generating returns. If you look at kind of the hyperscalers, they have invested in cloud infrastructure a few years back, and they're kind of reaping the returns now. And secondly, if you think about this chart here, I think this is actually the key chart, which shows you that, I mean, I think over the past few years, because everybody has been quite cautious on lending money, uh, it's actually quite hard to get credit, not just in the US, but in most economies. And with the rise of private credit, for example, there's additional kind of venue for companies to borrow money. because it was hard to borrow from the banks. So the private credit sector actually fills in the gap where the banks are not actually extending enough credit into the economy. And I think this is actually good support for the AI capex build out. Now, of course, are there risk, right? There is risk. There's a lot of risk in terms of this capex that gets built out, but not being used, right? If you and I are not using OpenAI, if we're not using AI technology, then I mean, all this capex actually goes to waste, right? And it's not going to generate sustainable returns. But I think as investors, I mean, this is something that we can observe, right? It's not rocket science. We all use these different AI tools every day, and a lot of these data as to, I mean, how many tokens are generated every day. These are kind of very, very transparent numbers. So I think just from our personal experience of using AI and seeing how it's transforming, not just the way we talk or we ask questions, but also the way we work, that gives you a good sense of how big this transformation is. And that's all matters, right? Because all this capex is basically being invested to build tools that serve people like you and me. So it's actually not that hard for you to track like how AI development is actually going. So hopefully that answers the question.
Thanks. So my next question is, with gold pulling back this week, what is Stashaway's outlook on gold, bullish, bearish, and moving forward to next quarter or two? Will Stashaway increase, maintain, reduce its exposure to gold?
Right. So again, let me pull up this chart. I mean, gold pulled back quite significantly in the last 2 weeks. But I mean, compared to its kind of 66% year to date, I think a 20%, even a 20% correction, I mean, still puts the year to date return to about 40%, which is still at the very high end of this distribution. So I think perhaps in the last month or so, there's been a lot of euphoria about investing in gold, a bit of FOMO as well. When I see, I was actually at the IFC Mall in Hong Kong, and I took a picture of people lining up in front of a gold store to buy gold. This is, I mean, typically very, very good signs that like we're in some kind of a bubble, I guess, a mini bubble, I would say. The only other store that had line was actually people lining up to buy Labubu. So it was like either gold or Labubu. But I think if there's a correction, and I think the correction is kind of a healthy correction because there's a bit of froth in gold in the past few weeks. I still think that over the long term, if you think about gold as a safety asset, and that's how we think about gold, right? Gold is not a is unlike stocks because it doesn't generate returns. It doesn't generate earnings, right? When you invest in companies, these companies actually generate earnings, and that is why you're getting returns from investing in stocks. Gold actually is just a gold bar, right? Its whole value depends on the other side of the equation because when you quote gold, it's actually always in another currency. So, for example, gold in US dollar, gold in Japanese yen, gold in Singapore dollar, etc. So the price of gold is actually reflecting the other side of the equation, which is the price of that sovereign dollar. And the reason why, I mean, gold has gone up so much, or the reason why we're positive for gold in long term is because we think that over time, it's the best hedge for lower US dollar or even kind of lower sovereign dollar in general. So that view actually hasn't changed with the run up in gold. If anything, if you look at kind of central banks, I mean, they're still buying gold on a consistent basis, and there's still a lot of room for them to switch from owning US bonds to increasing the allocations in gold. And I think that is a structural like support for gold.
Okay. I'm going to combine a few AI questions
Yes,
that have come in, which are fund managers also asking AI about AI bubble? Uh,
yes,
and also, how about China AI as right now, we've spoken a lot based out of the US.
yes.
How about the China angle in this story?
Yes. So I think if you look at this chart, which is I think where we refer to like kind of fund managers say calling out AI bubble, this chart changes all the time. So I think it reflects the sentiment at the time, and this was taken from last kind of early October. And I think over the past few weeks, you have seen some rotation out from AI themes. Although, I mean, today, stocks like Nvidia, AMD, I mean, they're all back to all-time high. But if you look at kind of some of the more speculative side of things, like for example, the nuclear theme or kind of quantum computing, I mean, these actually have corrected quite some time, quite a lot, right? For those companies that are that has less kind of I think earning support. They have actually, you can say that there's a bit of a bubble popping. I mean, even Palantir has been struggling for quite some time, right? So I mean, Palantir again is trading at 90 times revenue, and it was one of the favorites of like the AI second era. So I think to a certain extent that has sort of like the bubble has deflated a little bit from a stock market like valuation perspective. Um, but I think if you look at kind of where the bigger investors are moving money, I mean they're still moving money into like private companies like OpenAI, like Anthropic. These are still kind of ongoing investments. So I would say from a kind of public markets perspective, because these fund managers tend to be more shorter term, they're hedge fund managers, so they need to manage kind of the short term volatility. But for longer term money, that's still entering the AI investment boom. So I think I wouldn't call the. I think my conclusion is that as long as the Fed allows, as long as like inflation number still remains kind of quite tame, I think we're not yet we haven't seen maybe the peak of the bubble. And I think there's a second question, which is
On
to
China AI.
China, right? Yeah, exactly. So I think on China, they're trying to play catch up very, very quickly. And I think if you look at companies like Alibaba, they actually have their own models actually catching up quite quickly to some of the US models. And one of the curious things I picked up is that the model that, for example, Alibaba is developing actually works on the NVIDIA platform, which means that the code, whatever code that they write, I mean, they can actually port that to like Huawei chips, for example. So I think for sure there's a rush or there's a strong need for China to develop its own technology stack to make it kind of less reliant on US chips and also technology. But there's still a gap, right? Which is why I think in the US-China deal, like ideally, I mean, China would still like to get like the NVIDIA chips because they're still a few years behind. And US knows this, right? So I think if you look at kind of rare earth and chips, there is a curious kind of bionic relationship between the two. So for now, they still need to kind of co-develop. But of course, I think I guess the wave of the globalization has started since COVID, and that is not coming to kind of that is not coming back. So this is a structural theme that we've also highlighted for quite some time, and I think it's the AI era actually kind of make it even more pronounced.
Okay, then I think moving from the AI topic, a few questions are around, the sectors people, should be focusing on during inflationary growth, along with also, I'll tie the question together, which is, your thoughts on Berkshire Hathaway holding over 300 and I believe it's 340
Right.
billion in cash.
Yes.
So, how we look at the other pieces of other sectors as well as other asset classes.
Yeah. So I think in a inflationary growth kind of environment, obviously you need to have assets that are sort of, I guess, levered to stronger growth, which means kind of cyclical assets tend to perform quite well. And for example, in this case, at the same time, I guess the equity market tends to be a bit more volatile during inflation growth because you could get another 2022 if the Fed tightens interest rates for if inflation picks up. So it's also important to have some kind of more defensive, I guess, sectors. So, for example, one sector that we like still is actually healthcare. I mean, it has underperformed in the past 12 months or so. But I mean, healthcare is also benefiting from AI. Its valuation has corrected quite some time, and it's a good kind of, I think it's a good balance between growth and kind of defensiveness. So again, I mean, if you put kind of your if you put everything in tech, it can generate high returns, but also volatility of your portfolio is also going to be very high. So I think it's important to have a mix of several different kind of several sectors that would provide you growth. And I think having a mix of, for example, some tech, some techno, like some healthcare, even some consumer. I mean that these are all kind of sectors that would be benefiting from the inflationary growth kind of regimes.
And so in line with that, there's a question around that the top 10 tech stocks, I would say even, 6 or 7, have constituted a high percentage of the current US market cap. Does that worry you or affect how you weight the portfolios in US stocks?
Yes, but I think I guess if we look at yeah, I think if you look at the returns of these sectors, I mean they have done really well, and I think if in terms of valuation, yes, they are a bit more extended than the others. So as the U.S. economy kind of picks up growth from, I guess, more AI use, I think you could see a case where AI benefits starts to benefit other industries. So, for example, I mentioned healthcare, but also financials is another sector that could benefit from the use of AI. And once we see, because at the end of the day, you want to be investing in sectors that deliver the earnings growth. So far, we've seen AI benefiting from the tech sector to generate higher earnings growth. We haven't seen that much kind of filter through. But I think as AI technology gets kind of more spread out, you could see AI technologies like coming through in companies' earnings in other sectors, and I think that's kind of when I think more companies get lifted. Of course, the concentration in the U.S. equity market is very high today, but I guess we've also seen the support from earnings, and I mean for example, the Mac 7 earnings have grown 30% last year, and this is also outperforming the broader market. So at the end of the day, which companies are delivering the earnings? I mean, I think that's more important.
Sorry, I'll come back to a previous one which we missed, which was your thoughts on Berkshire holding
Oh, yes.
340 plus billion in cash.
Yeah. I guess I wish I have that much cash to invest. But I think for them, I mean, they're always I think they've done a fantastic job investing in Apple, and a large chunk of that actually comes from the realization of gains in Apple. And I think the problem with Apple, for example, is that Apple is probably the only Mac 7 company that is not really investing in AI, and it's sort of like relying on the iPhone, which is sort of the technology maybe of the last decade. And Berkshire is struggling to find another company at this size to invest in at a reasonable valuation. So, I mean, back to kind of their principles of investing, I think it makes it so hard for them to deploy such a big amount of capital. So I think that's a big Berkshire Hathaway problem. I think for most people, of course, it's a warning sign that the market may be kind of quite rich right now. But also, I think, again, going back to my point about earnings keeping to deliver, revenues keeping to double, triple, typically valuation is the last thing that you need to worry about if the revenues keep growing.
True. So maybe moving on from sectors to countries. What is your outlook, for countries outside of US, particularly the ones where our portfolios have positions in?
Yes. So we're still I guess we're underweight Europe. We overweight Japan. We overweight India, and I mean those are the areas where we think there are structural, like better structural growth stories. Um, and I know there, basically in the beginning of the year, there's a lot of enthusiasm about Europe, and we've gotten a lot of client questions about, oh, are you guys going to increase your weightage in Europe? And back then, we actually did a piece, and our conclusion was that yes. There are some changes in terms of fiscal policy that could filter through, particularly in Germany. But if you look at the structural issues of Europe, like basically like the I guess the population demographics, the very very difficult regulatory environment, and most importantly, Europe is actually not a fiscal union; it's a monetary union that prevents a lot of kind of I guess real kind of integration from happening. And we list out a checkbox that they need to check in order for us to get more positive. And so far, we've seen very little kind of progress in that front. So fast forward a few months, I mean, if you look at Europe today, Europe has actually given up all the outperformance that they've had in the first few months of the year. So again, like these things, these fads are come and go. We're not short-term kind of traders. We are investors in the long term. And for us, Japan is going through a reflation story that could last for years. Because if you look at Japan, it went through 15 years of deflation. And right now, they're starting to see inflation again. There is a lot of like investor interest in going into Japanese companies to increase the ROE, return on investments. And these are real structural stories. So we continue to kind of like the Japan reflation story. And then in India, even though I mean this year it's underperformed because I think number one, the valuation was a bit more expensive to start with, but number two, more importantly, I mean China has performed very well. And when global managers kind of look at the allocations between between India and China, they tend to kind of rotate between the two. But I mean, that doesn't change our structural view on India's capital market growth. And it's still, if you look at kind of the pace of growth is still growing at the fastest pace among like the emerging markets. So with the Fed actually easing, I think there is a case for emerging markets to kind of outperform the broader index again. China, we're still market weight. We're not yet overweight because we want to see actually the economic data to start picking up again, which I mean, slowly it's turning the corner, but I don't think there is a sustainable momentum yet for us to get positive on the overall kind of China story. There could be pockets. I think one of our attendees asked about China AI, and I think that is probably a very exciting area to kind of explore. But on a country level, there is still quite a bit of, I think, work to be done to turn around the economic growth.
Okay. So in view of inflation still above target in key economies, subdued, global growth and central banks beginning to ease with potential further cuts in 2026, the Stashaway believe we are entering a new market regime, and which sectors or regions are best placed to lead into 2026?
Yeah. So as I mentioned, in the ERA regime, we basically we don't call the change. When the change happens, our system detects it and we reallocate the portfolio. So far, I mean, we don't see any sign that we will be out of inflationary growth soon, and hence, I mean, our asset allocations remain constructive stocks, and we remain kind of preference on gold versus bonds. But of course, when things change, and if things change, we will for sure be very quick to detect the change and also to adjust the portfolios.
Okay. I'm gonna try to take a couple of last questions. There are still questions coming in.
Should we show the promo code first, because
Yeah,
I realized I forgot.
yeah, if you are here in whichever country you are, please, your next DCA in some help from our end as a free fee waiver. So please do use the promo code, and I'll continue to ask the questions on the side, and we can leave the promo code over here for everybody. So maybe next question is, what is Stashaway's view on energy related products, oil as well as nuclear? The AI revolution needs power.
Yes. And I think we've seen it manifesting in the stock prices of a lot of nuclear related companies and uranium in particular. So I think definitely with the data center bill out, that kind of 3 trillion, a large part of that is going into sort of energy development and sourcing of energy. I think if you look at some of the nuclear sectors, of course there are kind of blue chip companies, but there's a lot of also speculative companies. So I would just say that if the more speculative part, I would be very, very careful, because I guess the technology actually evolves so quickly that, I mean, today whatever is the development of the day may not be like the real development that's going to power the AI economy tomorrow. I think for oil, there is definitely still an oversupply problem, and the reason that oil is depressed is because the biggest kind of user of oil, which is China, as I mentioned, is still turning a corner, right? So if the China economy like starts to pick up in terms of economic activity, I think that's when oil could start to rally. But then the problem is that when oil starts to rally, then I mean inflation could pick up again, and this is kind of the risk that I talked about. So I think as fund managers, as kind of as allocators, we always think about risk. And I do think that, I mean, oil price, if oil prices kind of start to go higher, that could be a risk for our view. But so far, I think with the China economy still treading water, I think that risk is relatively low, at least in the next few months.
Understand. There's a question which we've been talking a lot about, more the public space. What are your thoughts on private equity, private credit investment versus traditional equity bonds in high inflation growth economy?
Yeah. So I think if you look at I guess our bond investment or our fixed income investments, broadly speaking, there are 3 sources that you can get higher interest rates like above the risk-free rate. So the first one is what we call duration, which means that you basically lend money for a longer time. So for example, if you buy US government 10-year debt, it means that the US government is actually paying you to borrow money for 10 years. So this is one way to get higher yield. And of course, like if you borrow some money, if you lend money to a friend for 10 years, you should demand higher interest rates, right? So that makes sense. The second source of higher yield is credit spreads. What this means is that basically you lend money to corporates with more questionable financial health. So if the friend that you lend to is more unlikely to return you the capital, of course, you would also demand a higher interest rate. The last source of higher interest rate is liquidity, right? If you say, okay, I lend you money, but then I mean I cannot get the money for like quite some time. It gets locked up. Then I mean that illiquidity, I cannot withdraw any money for like the next few years. That illiquidity is also a premium. So if you compare these 3 types of I guess liquid rate, I guess source of incremental return, today you get very little compensation for going longer duration. So for example, the 10-year US Treasury versus like your cash-free rate is almost the same. So it doesn't make sense to invest in high duration. Credit spreads, investing in higher risk companies, also give you very little return, and indeed the spread today is actually at a historical low. So investing in private credit is basically tapping into the third bucket of higher rates, which is from the illiquidity. Your money gets locked up, and you trust that the fund manager manages it to lend to high quality investors so that you get higher interest rates. And I think in today's environment, actually the third way, investing in private credit to get higher return is probably the safer of the three. Particularly, of course, you have to consider your own cash flow needs, right? Because if you need that cash flow to fund whatever expense that you need, then that illiquidity may not be applicable. But if you can kind of stash away or you can afford to have that money non-accessible for the next, let's say, 2 years, 3 years, or even 5 years, I think then private credit gives you extra return.
Yeah, and look, on the equity side, I mean, as you can see from the markets, in the news, I mean, there is just so much wealth that is today created in the private space. Companies are going IPO much later, and so equity as well, in terms of thinking about public equity versus private equity, does allow you to tap into a different pool that is just not available on the public market. But again, important to keep your risk profile and as Stephanie shared about your liquidity profile really in mind, because private markets do come with lower liquidity. I'm going to take one last question before we close, because the US tech valuations have been very popular today. So US tech valuations have rebounded sharply. Does Stashaway still see upside in large cap tech, or are you expecting a rotation into undervalued sectors like energy or financials?
I think I mean, if you think about kind of what is the story driving all these revenues or earnings, basically is I think two things. Number one is how strong is the economy, right? And number two, I guess where is AI reaping its benefits in terms of both top line and bottom line of companies. And as I mentioned, I think it's most obvious in the Mac 7 or in the tech companies. But also over time, I'd expect that to spread out to other sectors, right? AI benefits not just the tech companies. Of course, easiest way to benefit is, for example, I think both Microsoft, Amazon, Meta, they've all cut people because or they've saved costs because AI can actually do coding fairly well already. That development is slower in other industries. So, for example, take financials, take financial services, right? AI can help us to automate a lot of things, but there's a lot more regulatory hurdles. For example, there's a lot more kind of domain knowledge that needs to be unlocked. But if you look at, I guess, some of the recent announcement from OpenAI is actually recruiting senior bankers to train the models to replace junior bankers. And that is a huge cost saver. And I would expect this to be kind of not just confined to the financial industry, but also other industries as well. So I think as the benefits spread, I would expect earnings also to pick up for other sectors. And that's when kind of you see the broadening of the AI benefit. And the second thing is, as long as we remain in kind of a good economic environment, then I think it benefits most of the sectors which are tied to the economy, right? For example, materials, energy, industrials, etc.
I will squeeze one last question in because we haven't talked about this topic at all. Is what about the US government shutdown?
Okay. I think there's a reason why we don't talk about it is because I think the market is basically seeing it through. It's a nuance that we're not getting data, and it seems like the Fed is flying maybe semi-blind on some of the data that's not getting released. But I think from all the kind of analysis that I've seen, the impact to the real economy is actually quite controllable, and a lot of that is actually reversible. Of course, we're talking about just a few months of government shutdown. I mean, if the government shuts down for 2 years, I mean, that's a very, very different question. But I would think that given that the sort of like, I guess, the resolution is sort of expected in maybe I think and afterwards the reversal is going to be quite quick. I think the impact to market is actually quite limited.
Great. Thanks, everybody, and thanks, Stephanie, for the outlook today. Thanks, everybody, for joining us and giving us your time this Thursday evening. We have a really incredible client engagement team. If you have any questions, please just write in. They'll be more than happy to respond to your questions either via email or WhatsApp. If you are already a Stashaway client, you have the WhatsApp button right in the app. So if there's anything that we couldn't get to, please do reach out, and we'd be happy to answer your questions. But thank you so much for joining us today, and have a great evening.
Thank you so much for all the questions, and happy to have you all as Stashaway customers, and we'll see you next quarter. Thank you. Have a great night.